Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on our Econ show, we're going to break it up into our normal 5 segments. And in the first one, we want to talk about global growth slowing and why it's slowing, but we want to look at power costs and how that is impacting things and really how that is going to be an additional issue to the strengthening US dollar, the problems with rising rates, and really kind of make that connection and those problems that are going to continue to push down general economic activity. Then we're going to talk about the JOLTS data, which was the spark that lit a 100 handle rally, and why, yeah, it was good, but it's only, again, it's one piece of a much bigger puzzle, and you have to put it into context when you're looking at what the Fed is going to do, what the commentary is, and how this is really going to shape things going forward. And that's going to lead us to, when does that real personal consumption really slow, and how close are we to that pivot point? And then following the power theme, we want to talk about how power shortage fears continue to mount. There's more talk about brownouts and what that means for the European economy, given the fact that it's already under pressure. And then we're going to update everyone on the Chinese Caixin data and how that's showing an accelerating slowdown. China's currently on holiday this week, so it's a little bit of a shorter show. Yay, I know, only 90 slides instead of our normal 140 or so. So a little bit shorter. So we'll try to get through it in a normal, faster clip, if you will. So now when we turn to what is happening around the Russian side, so we talked about the Nord Stream 1 and 2, the issues there, full stop. We've had some Russian natural gas increase coming into Italy, but this just looks at where normal gas flows are and where current gas flows are. And I could show you how European storage is, which is in a good position. But when you look at how low the inputs are and the supply is, well, that's why demand matters so much, because you have to keep demand low if you want to maintain that storage cushion. But how do you do that without cutting petrochemical capacity, manufacturing capacity, and all these other reverberating factors? And just because of the shortages, obviously on the pipe gas side, people are relying more and more on LNG. So this is just giving you an idea of spot LNG tanker rates are sailing past previous records globally. And as we progress into the winter months, it's likely we're going to see another shift higher, just because we did this practice going around just kind of testing the waters. And if you call, the guys and I've had friends that do this, like, do you guys have anything available for January? And they just laugh and they're like, no, just get in line. Like, there's a ton of people that are looking to purchase because there is such a broad shortfall. So then when you start taking a lot of these shortages, that's where if things get really cold, or if you get a kind of a normal winter, there's already talk, the UK is discussing how there could be up to 3-hour brownouts, and that would be rolling through the system. But how do you manage an economy? How do you have a normal manufacturing backdrop if you're facing 3-hour brownouts? And that's where, it's done. It's done in the emerging markets. I'm not saying it can't be done, but this is supposed to be the developed world. This is supposed to be where you go and you're not worried about, am I going to have power for 24 hours in the day, instead of trying to plan when those brownouts are going to be. And you'll see shifts, like people will probably work more in the overnight when power demand is less. Try to minimize the amount that is done during peak hours, but it's going to change the way people work, the way people consume and travel, and that's this shift that is continuing. And this is just assuming that we don't have a snow bomb or some polar vortex that comes through, because that would create even more issues as we go forward. And it's important to look at, well, what are some of the other impacts that we're seeing? And when we look at the U.S., I think it's interesting to look at the amount of food that is going into ethanol. And this is looking at corn going into the ethanol pool, which obviously goes into gasoline. And it's interesting when you look at just the backdrop in the world today on the amount of food shortage, the concerns overall. Like Russia just came out and said that there's moisture shortages and that there's going to be a delay for the 23 planting season. And we're continuing to see those problems. Obviously, it's Russian, so you want to say, well, it's saying that to put additional pressure on the market on all commodities, which again, it's a coin toss, but it's there. If they are lying, it's not just them that's seeing the issue. There's others that are seeing the issue, and if they're not lying, they're just one of many places that are seeing problems when you look at the drought and on the other side of moisture on the both extremes. Then when you look at just the activity of Saudi Aramco and OPEC, we talked about the OPEC cuts yesterday on the EIA show, especially in segments 1 and 3. But I just wanted to come back to this chart because they're not buying debt, and especially treasuries. And when you look at what is happening in the market today for the U.S., and we're going to talk about this more in segment 1 as well as segment 2, there's a lot of volume that's in the world. There's a record amount of debt floating around. We've just been issuing and papering the town, not just the U.S. but everyone for decades at this point. And now you have China a net seller, Japan a net seller, the Fed, your most recent buyer, a net seller. The U.S. is still running a deficit. So not only are we rolling our old debt, but we're still issuing new debt. And you're seeing the buyers go away. And one of the things for those that have been following me for a long time, I've been saying is, who is the buyer of last resort? Because if you don't have a buyer of that debt, well, it's going to keep slipping, and that's going to keep pushing rates higher. And as rates go higher, that's going to stress emerging markets further. That's going to stress the market in general further, because the U.S. 10-year is typically the bellwether that sets the market, and especially on the emerging market world. And as that continues to drive higher, well, what is that going to do to the emerging market world? Like if you have to buy 10-year paper in the U.S. at 5%, which is deemed risk-free, what are you going to give Malaysia money at? Like, what are you going to give Nigeria money at? And that's when you see this increasing cost, which is on the underlying problem. And obviously, when you look at Saudi Arabia, they have been accumulating a significant amount on the current account side, based on prices. And given where things are, there's no incentive for them to stop. And that's where we continue to see them support pricing at these levels, which is why we've said from the beginning, it's just going to be here. Like, well, I don't think we go to 250. I don't think we go to 50. It's just, this is the world we live in when you look at general pricing. And some of the reasons why is when you look at how is electricity being generated, how is all of this coming through? So we talked about shortages of natural gas in Europe. We talked about shortages of food and how some of it's being misappropriated, if you will, in terms of going into the gas tank. But now you look at global lithium supply and demand. So demand is continuing to go up, and how is supply going to catch up? But then when you look at the electricity generation in general, China burns more coal than what the U.S. generates. And I think that is the biggest problem when you start looking at, well, we're relying more on China for green solutions, but they're building all of this using coal. So again, if we want to really go after a lot of this, we have to look at what is natural gas coming to the market in a greater quantity. What would it be if the U.S. were able to unlock more of our natural gas and LNG capacity and a lot of these stranded gas assets and replace 61% of China's coal consumption? And again, not that you'd replace all of it. India, 74% of their capacity is coal, and there's so much opportunity to do, like one of the companies we're invested in and tied to is flue gas capture. Do we capture the flue gas? Is there something we can do with it? And there's a lot of ways that we can really address these global problems and not push the EV agenda when you look at, well, how are the batteries being made? Where are they being made? What is the intensity of the EV? And is there going to be enough lithium, because price matters? And metal intensity of vehicles and power generation. So when you look at ICE vehicles versus a battery, the amount of aluminum, the amount of copper, the amount of lithium, obviously, the amount of nickel, depending on the battery, there is a lot that goes into making these batteries, these cars. But are they lasting any longer? What is by the end of their life cycle? Did they save anything else versus an ICE vehicle? And because all of those items require, aluminum, smelting. You have to, diesel to mine it, get it to the smelter, produce the product, refine it, take the refined product to the end user. All of that is done on diesel. All of that is done using natural gas or coal, electricity for the smelters. Then when you look at power generation, you get an idea of where gas and coal is versus wind and solar based on the aluminum, the copper, the zinc, the key pieces to, and obviously the rare earths, which is, I think, a bigger piece as well. But then when you turn around and say, where is it all processed? The answer is China. So we're talking about Russia as like the crown jewel of criminality on the fossil fuel side. We don't exactly have a great relationship with China, but yet we're going to trust them to do the right thing on the environmental side. They're doing all of this processing using coal power, and then we're taking it and putting it into a battery and calling it green. Like it's something that we have to address and look at things in general, because these poor policies are continuing to bite into making a sustainable and stable grid that we can rely on and continue to innovate and figure out the ways and the solutions, because there is going to be innovation. There's going to be ways to make this better. But by making power so expensive and brownouts all over the place, you're fighting against the tide. And that's when you start looking at where are some of the shifts in the U.S., because a lot of these green policies and a lot of these initiatives had the benefit of a really cheap 10-year yield, had cheap money. And if you look back of what I think is great, the era of irresponsible central banking, because everyone's talking about what the central bank is doing now is the worst policy decision ever. But it's like, well, where were you from 2012 all the way on? Like, what? Like, they've been making poor policy decisions the whole time, and now there's no chance where they have to pivot. They have to be tougher. They have to be tighten more than I think what the market wants. And I think I think it will be wrong, as hopefully the Fed has understood that artificially forcing real rates way below potential real GDP is a bad idea. And again, the issues are going to continue to drive things higher. And especially when you look at the shift, 80 trillion, so a combined value of US housing plus the stock market minus GDP, when you look at just the amount of wealth destruction that is a potential, given just how far and away above everything is from an asset price basis versus GDP, there's going to be that true up. And that's why when we talk to potential clients for the private equity side, and everyone's like, well, I'm in real estate. It's like, well, what is the value of that real estate? Is it something that is cash flowing? If it is, that's great. You can do a DCF. You can do a lot of different things to come to that valuation. But are we really going to be in a perpetual prices are just going to go up on the real estate side? Or are we going to get some of this true up, which I think is going to be the biggest concern, especially when you look at the strong dollar. And I think it's important because everyone's talking about the Fed and the dollar. And I think this chart does really well. The strong dollar isn't all about the Fed. There's obviously a piece of it. There's a chance for it in general. But if it were about the Fed, rate differentials would be rising sharply. But they're not. And that's the biggest thing. It's like they're rising, but not to the level that you would assume, given the fact that the dollar is approaching 112 again. The rise in the dollar is less about just sheer dollar strength and more about the weakness abroad. And even though the euro still is much stronger versus where it should be given the issues that they have, but also when you look at the yen, like all of this is essentially the US is bad, but other places are worse. Therefore, the dollar gets stronger. And that's where there's, I think, this misconception in terms of where dollar strength or how the Fed can adjust the dollar. Because if the Fed were to start easing, people are hoarding dollars right now. So if you're hoarding money, hoarding dollars, you're not going to see that same drop off. And that's when you start looking at the Fed is continuing to keep rates elevated. So the U.S. federal funds target rate, FOMC projections, has things tight through the end of 23. And that's when we keep talking about it, everyone keeps expecting the Fed to cut next year. And you're getting commentary from Kaskari, of all people, saying that, look, everything's going to stay the same. And I think that needs to be understood and appreciated really as we go forward. And that, again, the U.S. terminal rate at over 4%, I think, is going to continue to be the standing case. And again, drive rates higher because rates are going up. And the biggest underlying problem is the foreign holdings of U.S. Treasuries at Federal Reserves. Overseas central bank holdings at the Fed are under $3 trillion. And that's, again, that downward trajectory when you think about net sellers of holdings and those underlying problems. So then when you look at the global, just financial conditions, you're seeing things tighten. And as that tightens, people are concerned about inflation, concerned about liquidity. And that's when they're going out and they're liquidating their Federal Reserve, their treasuries to bring those dollars in-house. But they're not releasing them. They're sitting on them. They're hoarding them, which is why, again, you're seeing a lot of this concern on just valuation and inflation, which is keeping that dollar stuck. Then when you look at the most recent peak, financial stress index measures global financial stress markets from 33 variables. It reached its highest since COVID plunged, not yet eclipsing max stress during the pandemic or 2016, 2011, the great financial crisis, or the tech bust. So again, there's still more pain to go. And that's where everyone expects them to pivot, but it's like, we're not even where we've been previously. And we've only just started to see some sort of correction in some of these assets. And there's way more to go when you look at how things are going. So, rounding out the JP Morgan Global Manufacturing PMI, coming just right at 50. More downside as the developed market slows, as these pressures continue to mount, and the issues remain across the intermediate goods, the investment goods, but the consumer goods as well. Again, the intermediate goods is a good bellwether of what is to come, and you can see it is currently in contraction, which is, again, supported by the new export orders. Japan, US, France, Germany, world manufacturing is all moving lower. So global recession, Germany's new export orders in September manufacturing fell to 39.8. Again, global manufacturing PMI falls into contraction territory for the first time since 2020. And that's where, again, we just see more and more of that downside that is continuing to come through. With the manufacturing PMI output index, when you see the breakdown on the world level, we are now officially contracting. The Eurozone is obviously the biggest one pulling that down. But then when you look between August and September, you're seeing a lot of that additional slowdown rolling through. And that's something that we think is going to continue to accelerate, especially when you look at the pain at the developed world. Weekly change in foreign custodial holdings and deposits. So every week, the foreign central banks' holdings of U.S. Treasuries at the Fed custody facility are dropping fast, almost $40 billion in just 1 week. Again, seeing that down move, while year-over-year home price appreciation in the U.S. is coming down. It's still positive, but you're seeing a lot of this liquidation, and a lot of these issues are going to continue, again, to just weigh on the sentiment in the U.S., the sentiment in around the world, which is what is again driving some of these things lower. Container ships outside the port of Los Angeles, Long Beach, you can see here that they've continued to drop off, and that's pushed container freight benchmark rates down as trade continues to slow. And then when you look at the Asian currency index, you get an idea of just how painful things are, even as ASEAN manufacturing PMI, still remains fairly robust. You do get a lot of that moving from China into the ASEAN nations, which is where we've talked about some of the better opportunities still reside, especially in Vietnam. So these are, but the currency index is going to be the leading indicator for a lot of this PMI capacity, especially as you have liquidity dry up, you have dollar strength, you have these pressure points that continue to mount and create an underlying issue. So that's what we have for you on the world side. In the next segment, we're going to go deeper into U.S. data and the Fed and how a lot of that interacts and really kind of harken back to what we discussed in this segment.